few weeks back, I wrote an explainer of Joe Biden's tax proposal and received some questions about the following passage. I said, yes, there are times where it's beneficial to accelerate income, which is a counterintuitive statement because most of the conversation around taxes is that you want to pay as little as legally possible year in and year out. This isn't to ignore the debate around whether income tax rates are too high or too low. It's just that the natural bent for most people is to pay the least amount of taxes that the government allows with very little thought to the future. Yet that is not always the best route. There are scenarios where it's beneficial to choose to pay more in taxes. To illustrate, let's use the example of a couple on the verge of retirement, though we could just as easily use a couple in their mid-50s at the peak of their earnings power, or a business owner anticipating a few bad years. The chart that you see shows projected income and tax brackets for a couple throughout their retirement. And the most important thing to notice is that after the first 6 or 7 years of retirement, there's very little flexibility with taxable income because Social Security, which you see in light blue, and required minimum distributions, which shows up in green, those kick in. And whether or not all of that income is required to meet spending, taxes are being paid on it. It's also important to notice how the couple's federal income tax bracket increases as a result of this income. They're in the 12% bracket, which is that light blue line that slopes upward from left to right, and that's in the early years. And yet they're well into the 22% bracket, and that's that green line just a little bit above it that again goes from left to right sloping upward in later years. Finally, as I've circled on the chart, the lower income tax bracket in the early years presents a real planning opportunity. So the strategy is to realize additional income in the earlier years when only 12% in federal taxes is paid, to reduce the amount of income that in later years would be subject to 22% federal taxes. How that is done depends on a client's unique needs and goals. The additional income could be in the form of a Roth conversion if it isn't needed to meet living expenses, or it could be using pre-tax retirement accounts rather than after-tax brokerage accounts if that money is required to meet living expenses. The next chart that you see assumes the former strategy, that pre-tax accounts are used early in retirement to meet living expenses. That increases the amount of income subject to 12% taxation and then reduces the amount later that will be subject to 22% tax. Spending doesn't change. Goals aren't negatively impacted. The overall impact, though, is that less wealth is lost to federal income taxes. So while I've made some smaller points, really the main point of all this is that tax decisions need to be made with the long term in mind. Far too often, decisions around taxes are made using the mindset, how do I get my tax bill as low as possible this year? Yet by doing that, you're only delaying the tax bill, pushing it off into the future. Do that too much or without any long-term plan, and you create a situation, usually in retirement, and right around the time Social Security and required minimum distributions begin, where you have no flexibility. And not only is your federal income tax rate higher than it otherwise could be, but your Social Security taxes and Medicare premiums could also be higher. Now, this isn't to say that tax planning is some magical panacea. It's not. Tax rates can change, goals can change, circumstances can change. Taxes are a way of life, one of only 2 certainties, according to Benjamin Franklin. But with proper planning, long-term thinking, and collaboration between your financial advisor and tax professional, less of your wealth can be lost to taxes. As always, if you have questions, give me a call or visit our website to schedule a time to chat. Thank you.